evening, ladies and gentlemen, aspirant investor, aspirant venture capitalist, aspirant risk takers. Firstly, I'm unemployed. I have a Gmail address. So I'm not a venture capitalist by any stretch of any imagination. Secondly, lesson number one, for inspiring entrepreneurs, aspiring angel investors, people that are looking for the high risk, high return investment opportunities. No battle plan survives beyond the first shot. And these guys, that's why these guys have such wonderful stories to tell, that all the best intentions in the world cannot protect you from what's coming your way in the public markets. In the private markets, it's a completely different ballgame. My name is Cora Fernandez. I started investing in the private markets I'm going to make feel very old. So leave it at that, but I've been at it a long time. So firstly, maybe to draw a distinction, and I'm going to make sure I don't tell you stuff that you can read on Google. I'm going to tell you stuff from my first-hand experience and try not to give my age away. So firstly, when we look at a business, and I look at a business, it's my passion, and it has been for over 20 years, investing in private markets. When I look at a business, there's a spectrum on where the business is and what makes a business investable and attractive. As a person that's going to write out the check, there's a big difference between a person that will tell you how investable a business is as an advisor and the person that's going to write out their own check. So number one on the spectrum is let's call it the higher grade VC people, I refer to them. The people that have a product or solution that we don't know we need. It's like we never thought we needed cell phones. We were happy with telecom. That's higher grade, right? And then you move down the line, it's people that kind of tweak stuff or connect dots or connect platforms or how can you say, or arbitrage on an existing idea. That's the second group. And then you find the third group who kind of tweak a mundane idea, just solve a problem that everybody knows exists, and there are a couple of competitors. So rule number one for the inventors or the business owners or aspirant business owners or existing business owners and the investors. When someone comes to you, similar to what my predecessors, pre-speakers have said, and says to you, this is the best idea, or this is unique. It can be unique, but it's not compelling, because we can't scale it. And we know about someone sitting in a dark corner somewhere, either in Kenya, which is also emerging as our hub for VC, or someone sitting in India that can scale this thing much faster than you, then we are dead in the water. So do your homework about scalability. Make sure that when you say it's unique, it is truly unique, and you know who's going to put you out of business. The other trick with being put out of business in your idea, sometimes the person that's going to put you out of business, it's not the person that's doing exactly what you're doing, because you're fulfilling a need, and someone has found another way to fulfill a need. And let me give you an example how it plays out in real world. So when you're in business, you must look at the interdependencies of opportunities, and you must look at the speed at which the interdependencies converge for the people who are starting businesses. And that's where the gold nuggets sit in investing. By way of example, so I walk around, every time when I walk around, my partner will tell you, I always look at like, that's interesting, that's new. I wonder who was taken out of business because of that opportunity. I was presented with the opportunity to invest in a company that make these trolleys. You know the trolleys at the airport? So I thought about it. I didn't see the financials. I hadn't seen anything. They just liked the idea that I must participate and advise and do the normal VC/private equity stuff that I do. And one day at the airport, I'm thinking, why are the trolleys not stacking up at the, when you go to check in? I'm thinking, there used to be a lot of trolleys hanging around this entrance, like as you're going into a board. And I realized that the people that are making suitcases on wheels are the ones putting the trolley business out of business. Right? So it's those interdependencies, and they're all around us. So if we take our eyes off the screen and start look around, we'll have a lot of opportunities that we can see to invest in. So for the people, what makes a business investable? Firstly is this, will the customers value this thing that you are selling, big or small? Will they value it? And from a technology perspective, more and more you find sometimes customers will value it, but the legacy architecture in the business is the investment was too huge for them to rip it out, or they can't plug and play with your stuff. So it makes the decision-making process long, slow, cumbersome, and you find yourself with huge J-curves. So it's also the adoption, the rate of adoption of the technology. Sometimes things that are too disruptive have a very slow take-up rate, especially if the buyers are institutional, so you can end up in B2B business. So if you're trying to sell some IP, and then these guys in VC will tell you their experiences. If you're trying to sell technology solutions to a life insurance company, it's like it's in like another stratosphere, because those people have machines that have been fine-tuned by actuaries by over 100 years. They've sunk over R1 billion to that architecture. So if you try and pull out something there, I mean, you'll get approval from the government quicker. So it's that kind of thing. So just think about those things, because it doesn't help having a solution where you have a big customer base and people that need it, but the opportunity cost for them ripping it out is just, right? So think about that. And then sometimes we tend to go for the nice to have things, the top of the spectrum target customer base, which is because we think it's higher margin. You're going to make more money because the people can afford it. And it's not the truth. It's not always the case. It's actually seldomly the case. So what I've learned, I'm not going to say where I learned this quote from. The person said to me, it was one of these philanthropy type of places, and the person said to me, to become a billionaire, Cora, I decided I must help 1 billion people. And it kind of took me a while, and I was trying to think, because this was a philanthropist, I'm thinking, how did you help 1 billion people? And he goes, I don't give out stuff for free. So basically, this person made a product/service available that was accessible, cheap to 1 billion people. So think about that as you design stuff or make stuff. Think about the 80-20 rule applied differently. So does 80% of the population need it? And I'd rather have 2 Rand from 80% of the population than have 5 Rand from 20% of the population. Can you see what is more? Right? So think about it that way from a business perspective. What makes a business investable? Because everybody's been talking about the VC stuff, the sexy stuff that's very hard to do, by the way. It's very hard to do what they do. And it's very hard to find those gold nuggets. The other side of the sector is more the small emerging businesses that are tweaking existing products or solutions, or finding new ways of taking products and services to markets. And unfortunately, in this country, people use VC and SME interchangeably, and it's not the same thing. So for the people that have existing businesses, you may or may not be in technology. We'll call you an SME if you are small. But it's not a bad thing at all. It's a great thing, because they are very high growth businesses and very attractive. My first prize for investing, by the way. Attractive businesses. So the number one rule of what makes the business investable, don't believe a thing that you read on Google about this. Cash flow, not profit. We don't pay debt with profit. Profit doesn't pay dividends. Cash flow, accounting, you'll see the profit and the cash flow. It's not the same thing. We want the cash, not the profit. Rule number 1, cash flow. If you know nothing about accounting, go to an audit firm or someone, say, I just want to learn the cash flow. And it's easy. There's no funny rules. It's like how the money ends up in the bank. That last statement in the financials, that one. Ignore the balance sheets, that's ego. Ignore the profit, it's aspiration. Go for the cash flow. Focus on the cash flow, because the reason why I say on the cash flow, people will look at your income statement, tell you about margins and asset values and equity and all those ratios. I'm an accountant, so I can take swipes at them. They'll tell you all those stories, right? At the end of the day, when the bank or whoever funding person you go to approaches you, they want to know, what can you afford to repay back every month? The cash flow, not the profit, right? So that's why I always take swipes at the listed markets. I know quite a few people look like, those people here, the people here look like they have big listed equity portfolio. Please tell me, what does HEPS mean? Headline earnings per share. People get excited. It's up 20%. The headline earnings per share. Like, you don't get it in cash, right? It's just a number. Then it's like 4.25 is your headline earnings per share. Your dividend is 78 cents. Thank you for coming. No. That's the difference between headline earnings per share and dividend. So that's why we focus on the real world. We don't work with those acronyms. Cash flow, that's the money in the bank. And then finally, what I want to tell you, that is something that you will not find on Google or not experience, not know unless you've experienced it firsthand. So when you're looking at funding, they are equity investors. They don't give out loans. When they give you money, they're taking a share in your business, and they're going to come with rules, but they'll help you. But before you get there. So rule number 1, if you are done bootstrapping, when you've borrowed from all your family and friends and you've tapped it out, right? The ones that you don't have to pay back. Now you are focusing on the cash flow. Those ones. Now you're focusing on the cash flow. The first place you go is the bank, senior lenders. Then you look at assets. If it's your mother's house, something on the father's will, borrow it. That's the cheapest source of funding. And the reason I say that, people don't like it when I say it, but it's the truth. If you work out the economics, that's how it works. It's the cheapest form of funding. People think it's a swear word. It's a great source of funding. I don't have a bank. I don't give out money for debt. So I'm not selling for anyone. I'm just saying, if I was in anybody else's shoes that's looking for cash, that has tapped out all the traditional first-line sources, they don't take equity in your business, and you can still continue operating the business as you do. The only rule they give you is your cash flow must be X. It's like you must keep paying the bond. They like the bond, but not for 20 years, maybe 5 or 7. That's the first part. If you get halfway into the repayment, then they'll give you some more money. And you still own your business. You have strange characters here and around the table, and now you must write reports and that. None of that. Number 2, if the family comes and wants their money, you show them balance sheet, say, look how much I owe the bank. Then they stay away. Right? It's the safest place to start. And now you are getting big. So we're at the bottom of the balance sheet. Now we're getting big. There's another group of people that lend money that nobody talks about, and they're my favorite funders on the planet. They call mezzanine. They're like between the bank and your parents. So you pay if you can, but you don't have to. All right? And then you can decide later on, okay, you can have a stake in my business. Because I've had a dry run, I can't pay you, let's convert it to equity. But you decide when. But again, the cash flow must be sorted. They're not interested in the other stuff, they want the cash flow. So mezzanine funders. And when you are tired of the mezzanine funders, obviously the price goes up. As I go up, the cost. This will be prime plus 2, maybe prime minus. These ones are prime plus 3.5, 4.5 basis points. Then you get to these guys, the equity guys. So if you're in VC space, tech space, you'll go to the venture capitalists. If you're not in the venture capital space, you go to the private equity guys. The guys that do everything but tech. Those guys. Those are the expensive guys. Or the guys that want shares and structures and governance and reports and all that. But if you are growing your business, they are actually a great source, the venture capitalists and the private equity guys. They are a great source of finance, but it can't be your first place. Right? If your business is generating cash, and you have a handle on what's going on, and you have friends and family that you can sit and think through, and the entrepreneurship journey isn't lonely, and you have people that give you free legal advice, free corporate finance advice, then you don't have to go there. Like, first sort out yourself, make the valuation big, and then you go to them. Because you don't want to sell if the business is small. Because he's going to value your business very properly, but you're going to end up with your valuation is say 50 million. But if you give it 2 more years, it can be 200 million. You understand? So now you're selling 10% for 5 million, you could sell 10% for 20. You see? So you end up losing control if you try to sell too early. And I know everybody wants patient capital. My rule of advice is focus on the cash flow, and the patience will come later when the business is bigger. So thank you very much.